All right, buckle up, curious minds, because today we're peeling back the layers on a major player in India's fashion scene, Arvind Fashions Limited, or AFL. We've got a stack of fresh sources for this deep dive, their official press release, the detailed investor presentation, and their financial results, all related to their first quarter performance for FY26, ending June 30, 2025.
Yeah, and our mission today is really to go beyond just the headline numbers,
Yeah.
to truly understand what drove AFL's performance in Q1. We'll uncover the key financial highlights, sort of dissect their strategic moves, and see what this tells us about the broader Indian apparel market. You'll walk away with a clear picture, hopefully, of their recent progress and what they might be planning next.
Okay, let's unpack this then. The first thing that jumps out usually is the overall financial performance. What were the headline numbers for Arvind Fashions in Q1 FY26? Like the top line.
Right, so looking at the consolidated results, Arvind Fashions reported uh, pretty significant 16% revenue growth. They hit ours 1,107 crores in Q1.
1107 crores, okay.
Yeah, that's a solid jump from the RZA 955 crores they did in the same quarter last year.
And the profitability, because, for many companies, that's where the real story often lies, right? What did you find maybe most compelling on that front?
Absolutely. So EBITDA, that's earnings before interest, taxes, depreciation, and amortization, it saw really robust growth, 20.3%.
20%, wow.
Yeah, climbing to ours 148 crores compared to ours at 123 crores last year. And this actually led to an EBIT margin improvement of 50 basis points. So it reached 13.4%.
Okay, but what's genuinely interesting here, I think, is that this margin improvement happened even though they increased advertising spends quite a bit, like 140 basis points higher year on year. How did they pull that off?
That is a great question. And it really highlights, I think, their operational prowess. It suggests they're getting more, bang for their buck.
Right.
Maybe better ad targeting, or perhaps just improved execution that converts those ad dollars into profitable sales more effectively. And when we look at the profit after tax, the PAT, the story gets even more compelling. It saw a multifold increase, jumping from just as 1 crore in Q1 last year to ours 13 crores this Q1. That's for their continuing business.
13 times. That's huge.
It is. And it's not just a positive number. It signals a pretty significant turnaround in net profitability, maybe moving them from, stabilizing to more of a growth acceleration phase.
So this kind of leap, what does it mean to their leadership? What did the MD and CEO, Mr. Shailesh Chaturvedi, actually say about these results?
Well, he called Q1 FY26 a bright start, and he attributed it directly to conscious efforts of investing in higher marketing to re-energize our industry-leading brands.
Okay, so leaning into marketing.
Exactly. He
Yeah.
explicitly linked these investments to aiming for strong awareness and higher footfalls along with market share gains. And he also emphasized a continued focus on their direct channel strategy.
Right, the direct channels.
Yeah, for improved bottom line and ROCE, that's return on capital employed. And the thing about direct channels is they often give companies better control over pricing, inventory,
Mm-hmm.
which, combined with their asset-light expansion strategy, can directly boost that ROCE, makes their capital work harder.
Makes sense. So we know the numbers look good, but how exactly did they achieve this growth, specifically across their different sales channels? What were the strongest drivers there?
Well, the growth was pretty strong across the board, really. But that deliberate focus on direct channels, it really paid off. The online B2C channel, business to consumer, grew by over 30% year on year.
30% online, okay. And what about their physical stores, their traditional retail presence?
Retail saw about 15% growth. And importantly, the like-to-like or LTL growth was 8.1%.
LTL, stores open at least a year.
Exactly. And that was helped by superior execution and actually lower consumer discounting.
Yeah.
Even the wholesale channel selling to other retailers saw a healthy rebound, over 10% growth year on year.
Interesting about the lower discounting. It sounds like they're definitely shifting their sales mix towards those direct channels. Can you give us a clearer picture of how that mix looks now?
Yeah, definitely. If we step back a bit, the channel mix for Q1 shows online B2C increasing its share to 15%. That was up from 13% last year.
Okay.
Retail, though still growing, of course, its share slightly dipped, 23% from 24%. Wholesale stayed stable at 44%, and the others shifted slightly. So yeah, it clearly indicates that deliberate push towards more direct-to-consumer engagement. Give them more control.
Right, control over the brand experience and pricing. Now, AFL, they're known for this impressive portfolio, right? U.S. Polo, Asim, Aero, Tommy Hilfiger, Calvin Klein, Flying Machine. Were there any standout performances or key initiatives from these specific brands?
Oh, absolutely. Each brand sort of chipped in differently. U.S. Polo Assa, they
Mm.
saw big marketing investments, and that yielded strong Q1 growth everywhere. The direct channel strategy really boosted their revenue share. Plus, they opened some, marquee, larger stores. Good visibility.
Yeah.
Arrow, they benefited from, well, favorable trading dates and the wedding calendar, apparently. Product innovation, like something called Arrow Elixir, and this
Yeah.
Arrow New York line pulling in younger customers, those were highlighted. Plus, more EBO expansion.
Bebo's exclusive brand outlets. Got it.
Then Tommy Hilfiger delivered strong LTL growth in retail, and they curated specific lines just for department stores, positioning it well financially.
Mm.
Calvin Klein, they leveraged a collaboration with Formula One. That apparently led to strong brand awareness and high LTL growth. Shows the power of those partnerships.
Yeah, interesting tie-in.
And finally, Flying Machine showed industry-leading sell-throughs, good LTL growth, helped by the premiumization trend, delivering strong results even though demand was maybe a bit tricky. Flying high, you could say.
Okay, so given this push towards direct channels, and you mentioned EBO expansion for Aero, how does their overall store expansion strategy tie into all this?
Right. So AFL reported adding 29 gross EVOs in Q1. That brings their total count to 987 as of June.
Nearly 1,000 stores.
Almost. With about 38,000 SGAF net addition. And for the full year, FY26, they're aiming for around 150 gross openings. Mostly through that FOFO route, franchise-owned, franchise-operated.
Ah, the asset-light approach.
Exactly. Lets them expand their footprint without tying up loads of capital, which, again, helps that ROCE number we talked about.
Makes sense. We touched on the improved EBITDA margins earlier. How did their growth margins do, and what was the impact of cost management there?
Gross margins expanded by 60 basis points to 55.9%. And this was, like we noted, largely helped by lower consumer discounting.
Which is a powerful sign, isn't it?
It really is. It suggests their brands have gained enough strength, enough appeal, that they don't need to slash prices constantly to move inventory. It's not just about higher profits today. It's about validating their brand equity, their market position. It signals a more sustainable path.
Yeah, that's a really strong signal about brand health.
Yeah.
Okay, and how are they managing assets like inventory, working capital, especially with this strong growth happening?
Well, despite that revenue acceleration, inventory turns are staying stable, ARN 4x.
Okay.
And net working capital, NWC days, that measure of how efficiently they manage short-term assets and liabilities, also stayed stable at 59 days.
So, growing efficiently, not tying up too much cash in stock or receivables.
Precisely,
Yeah.
which is crucial for cash flow, obviously.
So, looking ahead then, building on this strong quarter, what are their stated goals for the full FY26?
They've laid out some pretty clear objectives. First, sales and profitability. They're aspiring for 12–15% revenue growth, looking for acceleration in adjacent categories too. And they expect operating leverage to keep expanding those EBITDA and PAT margins.
Okay, ambitious, but based on Q1 seems possible.
Second, brand salience. Plan is continued investments in advertising to drive market share gains. Aligns with what we saw. Third, direct channels. Aiming to grow the share of direct channels retail plus online B2C by another 100–200 basis points. Better inventory control, better profitability. And finally, working capital and return ratios. Goal is higher free cash flow through continued working capital efficiency and that asset-light approach, all leading to further improvement in ROCE.
Okay, clear targets. Now, beyond their own performance, what's the bigger picture? The market, the economy in India right now? Any major tailwinds or headwinds for a company like AFL?
Well, the market has seen an early start to the end of season sales, the EOS, and generally higher discounting across the industry.
More competitive then?
Yeah, but stronger brands like AFL they continue to drive higher market share, even in that environment. On a more positive note, there's a favorable monsoon expected. That should help keep raw material costs and inflation stable, hopefully easing some input pressure.
Okay, stable costs would be good. What about consumer demand overall? Is that picking up?
Consumer demand generally remains, well, somewhat muted. That's the general feeling. But government efforts, and importantly, the upcoming early festive season, are anticipated to provide a significant boost to consumption, hopefully.
Right, the festive season is always key.
Absolutely. So, given this, cautiously optimistic external environment, it's clear AFL's strategy is really laser-focused. Investing in growth drivers for better than FY25 revenue growth, accelerating retail expansion with that asset-light model, and scaling their brands, including those adjacent categories.
It definitely sounds like they're balancing that aggressive growth push with a very keen eye on efficiency. But, given the generally muted consumer demand you mentioned, are there potential risks? Could that challenge this outlook, especially if, say, the festive season doesn't deliver as strongly as hoped?
That's a really crucial point, yes. While they have strong brands and a clear strategy, if that consumer sentiment stays muted for longer, well, it could definitely put pressure on their sales targets.
And force them back to discounting.
Potentially, yeah. Which would obviously hit those gross margins they've worked hard to improve. And also, while the asset-light FOFO expansion is smart, you know, ensuring consistent quality and brand experience across a rapidly growing franchise network, that's always a challenge.
Maintaining brand integrity.
Exactly. It's a delicate balance they need to strike.
Well, this was a truly insightful deep dive into Arvind Fashion's Q1 FY26 results. We saw impressive growth, revenue and profit, clearly driven by that focus on direct channels and strategic brand investments.
Yeah, what really stands out to me is their ability to improve profitability, those margins, even while ramping up ad spend. It showcases strong operational leverage and, like we said, that keen eye on reducing discounting. Their forward-looking strategy also highlights a clear path, but yeah, not without those market challenges we just discussed.
Definitely. So, as you, our listeners, consider all this information, here's maybe a provocative thought to leave you with. How might this anticipated rebound in consumer demand, if it happens, coupled with AFL's really aggressive direct channel and marketing push,
hmm
how might that reshape the competitive landscape for other fashion players in India over the next year or so?
Good question.
Will smaller players struggle to keep up? Or will a rising tide maybe lift all boats? Something to mull over as you continue your own deep dives.